We've got some examples here. We've got our type 2 and type 1. These items should be all investigated if they occur after the period end and before the auditor's report issuance date. Now, we do have items that might happen after the report issuance date. We'll address that. In general, what I like to say for this, as an auditor, think as if you were the shareholder of the company. Well, you're doing this audit on behalf of the shareholders. It wouldn't hurt to put yourself in their shoes. A shareholder is the owner of the company. What would the owner of a company want to know about? I think that's a great mentality to have. You're the auditor. You're auditing the company for the benefit of the shareholders. So pretend you are a shareholder. What would you want to know about if you were an owner of this company? You would want to know about these items, which should be disclosed but not accrued if they're significant. Loss of the factory, warehouse, plant, anything from a fire disaster. Maybe you lost a significant customer, right? Maybe you're a manufacturing company and you sell 25% of your sales to one customer, but then that customer goes under or they just break business with you. They don't want to buy from you anymore. That's a big deal because that would result in probably 25% of your revenue decreasing in the next year. Any mergers and acquisitions, that wouldn't affect the current year under audit, but it'll affect next year. And you want to just say, hey, yeah, they just bought a massive company or they just merged with another company. That would be significant enough to talk about. But also sales of major accounts such as bonds, business segments, assets. They just sold off all their debt. If they completely changed their equity structure, anything like that, something you should probably disclose. And then also significant declines in the fair value of assets, right? Just a couple examples. This is not exhaustive. There are more examples. These are just the more common ones. Also, events that occur after the period that should be accrued for the current period, which are type 1 events. Resolutions of lawsuits which arose in the audited year. Again, there's a lawsuit happening in year 1. We find out the result of the lawsuit in the beginning of year 2. We should account for it, whether it's a gain or a loss. Sometimes you could win a lawsuit and gain money. Also, sometimes you lose lawsuits, and fortunately, you'll lose that money there. You should accrue for that in the year under audit. New information being discovered about items not accounted for on the current period's financial statements. This should always be investigated, even if after the auditor's report issuance date. We'll get into that more in a bit. All right. Let's just say, for example, you find a bunch of inventory hidden in a warehouse that no one knew about. Yeah, it relates to the current year. You should have that included. It was a mistake, right? Maybe just no one saw the inventory. It was hidden away. But if you find out about it, yeah, you got to go back and adjust the financial statements for it. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.